Let's get the thoughts and opinions of Noureldeen Al Hammoury, Chief Market Strategist at Equiti Group. Noureldeen, great to have you on the show. Thank you for joining me. So oil prices...
Thank you for having me.
Pleasure. Oil prices have seen the biggest single-day spike in 6 years. What did you make of the increases in oil we saw earlier today amid the Iran war? They did shoot up, but kind of stabilized a little bit now.
I mean, what we saw today or earlier during the Asian session, markets rapidly pricing geopolitical risk rather than just a traditional supply shortage. As everybody knows, nearly 20% of global oil flows pass through the Strait of Hormuz, which is officially closed, or at least the tankers traffic is down by more than 95%. And when traders fear disruption to the corridor, prices can move very aggressively. The spike, of course, we saw again, as I said, during the Asian session, reflect panic buying, at least in the physical market. But at the same time, there's the problem now. It's not about production. It's not even about storage. It's about delivery. Mm-hmm. And the fact that prices stabilized slightly afterwards suggests traders are now waiting to see whether the disruption to shipping becomes longer or it's going to be temporary. Over the past couple of minutes now, we're hearing the U.S. President Donald Trump talking about he's looking into measures in order to put down a little bit, at least some sort of a drag from the oil rally. That includes some sort of tax cuts. You're talking about higher deficit once again.
So oil has stabilized for now after hitting $120 a barrel, as you mentioned, after that large spike at the Asia Open. But do you fear the upward trend could actually continue from here? I mean,
at this stage, now we're in the end of the first or the beginning of the second week of the war, and further upside is the risk of further upside remains, because one important thing, that logistics situation is still the same, and if it deteriorate even more, this is going basically to keep on pushing oil higher. What matters now is not only how much oil is produced, because it doesn't matter, but whether it can safely be transferred or to reach the global markets. If tankers traffic through the Strait of Hormuz remains very constrained, which is the situation now, markets could price in additional risk premium very quickly, and in that scenario, oil could easily test about, I would say, 120. We would go back again, and even 130 and even $150 would not be something that I would take it off the table.
Yeah, and I was just about to actually ask you that, Noureldeen, as we're talking. I was thinking, how high do you think oil could go? Do you think it could be 150, as you just suggested, or possibly even higher?
Yes, possibly even higher. I would say that as long as the traffic is now down, there is no reason for oil to stay stabilized. Even now, I would say the decline that we saw over the past couple of minutes, it was just basically a reaction of the verbal intervention of many countries. That includes also the G7. A couple of minutes ago, we saw some statements saying we are ready to release some sort of from the reserves, but we are not there. We're not there yet. So verbal interventions, we will have to wait and see how this is going to play out. But at the same time, if nothing changes on the ground from the security of the Strait of Hormuz, I see no reason why oil cannot be over 150 even.
And let's talk a little bit about the G7 countries, because, of course, they were meeting. They've said it's not ready to release emergency oil and gas reserves just yet. But do you think this hesitation is risking further spikes in energy prices and economic pain for consumers?
That's what we always see from when it comes to politics. Strategic reserves release can help stabilize markets in the short term, adding some immediate supply and reassuring traders and governments that they are prepared to intervene. However, the effectiveness depends on the nature of the shock. If the issue is purely supply disruption, reserves can ease the pressure. But If the problem is the transportation risk or shipping disruption in the Gulf, then reserve release tend to provide only a temporary relief unless or until the geopolitical situation improves. No geopolitical situation improvement, then the price of oil might even spike even higher. And to the point, Russia even intervened verbally, saying they are ready to supply Europe with energy if they ask. So we're seeing, again, it's the verbal interventions, and the market is back into wait and see mode. What happens over the next couple of hours?
Yeah, absolutely. It feels hour by hour right now, doesn't it? But how much upward pressure could this put on global inflation? And which sectors are likely to feel it the most? Because we're not just talking about oil when it comes to gas in your house. It's flights, it's tourism. It's directly linked to so many things.
The war came at maybe the worst time. Inflation was already sticky. Yes, we had a situation where disinflation was faster, but at the same time, most of the inflation was sticky. Oil above $100 tends to push inflation higher quite quickly because, as you know, energy feeds into almost every part of the economy. Transport costs rise, manufacturing costs rise, or increase, and food prices often follow because of a higher logistics expenses. The sectors that feels the first, at least, are airlines, transportations, chemicals, heavy industry. But if the rally basically persists, the broader concern for central banks is the higher energy prices could slow the disinflation trend and complicate decisions around interest rate cuts, which was supposed to happen this year. For example, the Federal Reserve was expected a day before the war to cut rates by twice from now until the end of the year. But now markets are not pricing any rate cut. Matter of fact, there might be even a chance the Federal Reserve will be forced to even raise rates if this conflict continues for more than maybe a month or like 4 to 6 weeks.
Noureldeen, yes, you're absolutely right. Could affect those rate cuts for the central banks globally, but great to have you on the show. Noureldeen Al Hammoury, thank you once again.
Thank you for having me.
So what does this all mean for the shipping industry? We are now joined by Marcus Baker, who is the Global Head Marine of Cargo and Logistics at Marsh Specialty. Marcus, it's really good to have you on the show. I was just having a chat before to someone who was talking to me about oil, saying that it could go above $150. And right now, he was also talking about the Strait of Hormuz. We know that shipping through the Strait of Hormuz, as I'm talking to you, is sharply reduced as the US-Iran enters the 10th day. How is the insurance market reacting to the continued challenges in this region?
Yeah, I mean, it's a great question. And clearly, you know, one of the things that we look at is, I suppose, the perspective, the risk perspective and how that looks at the moment. The insurance market itself reacted in the way that we traditionally expect it to. There is a very well-defined mechanism to deal with situations like this. And as of the middle of last week, and certainly well into the back end of last week, insurers were offering prices for ships trading throughout the region and up into through the Straits of Hormuz. Now, that's a bit of a moot point, as we've discussed. When you have traffic down by 95%, it's really a factor of do people really want to go up there rather than the insurance pricing, in my opinion.
And it's so interesting because, like you say, that there is some pricing there, and you don't sound to me that you're too concerned in many respects. So is cover available, and how costly is it?
Yeah, so I mean, what we saw weekend before last, as the action hit, notices of cancellation were given by the market to most of the ships that were up in that area and were thinking about trading in there. And the reason they do that is that they have, under the terms and conditions of the policy, the opportunity to re-rate the risk depending upon the risk environment that they're actually seeing at that time. And that's exactly what happened. So to give you some context, before the activities in the region prior to last weekend, the rates were between 0.25 and 0.5% to go up to the Persian Gulf, and that is on the value of the ship. So a VLCC at $100 million, a 10-year-old VLCC, that's between $250,000 and $500,000 per voyage up into that region. What we're now seeing are rates anywhere up to 3% and possibly beyond. So, albeit a significant increase, but I think when you look at the overall sort of cost of the voyage, if you like, the value of oil, as we've just discussed, could be $150 a barrel. Well, $150 a barrel is not out of line by the sounds of it. So when you've got a VLCC carrying 2 million barrels, that's a lot of cargo, a lot of valuable cargo. So the increase in insurance cost is a relatively small part of that overall cost.
And you think that the companies are just happy to absorb that increase in order to make it through the Strait of Hormuz and the Persian Gulf?
Well, look, I mean, I think you know where that cost goes. I mean, ultimately, it's going to hit the consumer. And, that's just a fact of life, I'm afraid. But the consumer is going to be hit by higher costs of the per barrel of oil rather than another couple of $1 million or spread over 2 million barrels of oil for one VLCC. So, I think relatively speaking, the insurance piece is a smaller part, perhaps, of this overall position, but it's still a significant part of it because ships, frankly, won't trade up through that area unless they've got insurance.
Absolutely fascinating. Marcus, what do we know about the agency President Donald Trump says will ensure ships sailing through the Persian Gulf? And will it have any impact on the insurance market? Because it's quite interesting what he announced there.
Yeah, we've not really seen anything like this before. I mean, we at Marsh were privileged to do a lot of work in Ukraine when Russia first hit, and we did with the insurance market create a facility that supported grain shipments in and out of Odessa with the help of Ukrainian government money, and so. When I say nothing like this has been created before, I mean nothing on this scale. They're talking about a very significant input of money. What we don't know yet is how it's going to work. Any additional capital is going to help with costs and reducing pricing, but we really don't know what the impact, how it's going to function mechanically, the impact it's going to have in terms of the collaboration with the insurance market, which will be necessary. So I think once we've got that, it will enable us to reassess the position. And the other thing it may well do is offer a degree of confidence in the shipping community.
The devil's always in the detail, but I want to talk a little bit more to you about, we spoke about the companies absorbing that extra cost of insurance in order to get the oil through the Strait of Hormuz and the Persian Gulf. But how do you see this affecting the consumer in the end? Presumably, it's more than beyond the price of oil. So we talked about the absorbing cost, that cost being passed on.
Yeah, again, very pertinent question, because clearly that region is not just about oil. I mean, oil, as we heard your last speaker say, 20% of the world's oil comes through that region anyway. So it's very important waterway from that perspective. But above to the west of the Strait of Hormuz, you've got Qatar, Abu Dhabi, you've got Dubai, and all of those territories need stuff. They need to support their tourism industry. They need stuff to build. And so that tends to arrive by ship. So large container carriers going into the region, bulk carriers with other commodities trading up into that region as well, will all have to pay an additional premium to transit that region. And so I think, we will see, or certainly people that are living in the Middle East will start to see an increase probably in their day-to-day costs as this starts to manifest itself. I mean, the other thing I would say, there's 6 cruise boats up there at the moment with 18,000 people on board. So at some stage, they'll look to try and get off of those boats when they can fly them home. And I think the biggest issue, frankly, with this whole thing is crew. And the days are gone when I think crew would just go through a war risk territory and not really worry too much about it. The munitions have changed. The accuracy of being able to hit a ship's changed. So it's become a much more perilous job than it ever was before, and that's not even considering going into a war risk trading area. So if crew are anti going up there, that's going to make life even more difficult. It doesn't matter what we do from an insurance market perspective, those sorts of impacts are going to be significant.
Marcus Baker, thank you so much for joining us. Great analysis, fascinating. Thank you.
Thank you.